I'm Nikki Jovicic from LookUpStrata. I'm also the Managing Director of Tower Buddy Corporate, and I'll be your host for today's session. Conflicts of interest are nothing new in strata, but over the last few years, the industry has been under even sharper scrutiny, whether it's strata managers receiving insurance commissions, developer appointments that raise questions, or deals made without the knowledge of owners' corporations. These arrangements can significantly impact trust, governance, and transparency within a scheme. Today's webinar is based on a major new research report by Dr. Nicole Johnston from Strata Knowledge, released late 2025, called At the Crossroads, Addressing Pervasive Conflicts of Interest in Strata Management. Nicole's work has sparked a national conversation about how industry practices operate behind the scenes and what reforms are needed to restore owner confidence. She'll be taking us through the key findings of her report, including how different business models influence decisions, why disclosure often isn't enough, and what practical and policy changes could make a difference. If you're a strata manager or committee member wondering what all the recent debate is about, or just trying to better understand the risks at play, today will help you connect the dots. This is a national session, so with inclusivity in mind, we are aware that terminology changes across Australia. So if we're talking about committees, that's also known as the Strata Council or Council of Owners. And if we're mentioning Owners Corporation, we're talking about body corporate or the strata company, depending on which state you're joining us from. And as always, the content of today's session is general in nature and doesn't constitute advice. So if you're dealing with a specific issue in your scheme, we recommend that you get independent guidance. Let's meet today's presenter. Dr. Nicole Johnston is the founder and director of Strata Knowledge, a socio-legal researcher and former commercial lawyer. Nicole has led multiple national studies into strata governance, building defects, fire safety, insurance, and developer conduct. She holds degrees in psychology, criminology, law, and a PhD in strata and community title governance. Dr. Nicole collaborates widely with government and industry, and her research continues to shape policy and practice across the sector. So At the Crossroads is her latest project, and it's supported by New South Wales Fair Trading.
So good morning, everyone, and thank you for joining this webinar. Today, I'll be presenting findings from research that I believe represents a pivotal moment for the strata management industry in Australia. The title, At the Crossroads, is deliberate because the industry genuinely is at a critical discussion point. This research I'm sharing today was conducted in partnership with New South Wales Fair Trading and examines the systemic conflicts of interest that have become embedded in how strata management operates. So let me briefly outline what we'll cover today, and I've structured this presentation into 6 main areas. So we'll start with context, so understanding the historical background and why this issue has reached critical mass now. Then we'll establish a conceptual framework for understanding conflicts of interest, because there's a lot of confusion about what actually constitutes a conflict of interest. And this is really central to our discussion. I'll then walk you through our research methodology, which I know can be a bit boring for some, but I think it's really important that we all ask questions about how research is undertaken and who's undertaking research. So this was a comprehensive multi-phase study. Then we'll examine the key findings, what the evidence actually reveals about industry practices. We'll discuss the severity of different conflicts of interest risks. And finally, I'll share our recommendations for both policy reform and industry change. So this is about a 40-minute presentation. So I'll need to move through some sections quite briskly, but I encourage you to access the full report for the complete analysis. And I think Nikki has shared a link, but otherwise you can go to the Strata Knowledge website and get a copy. It's sort of out there in the public domain. The strata management industry is genuinely at a crossroads. On one hand, there's a real opportunity for the industry to transition from what I'd call an occupation-based model to a truly professional one. But there's the obstacle. Conflicts of interest have become so deeply embedded in standard business practices that they've become barriers to that professional evolution. We're talking about commonplace practices that are fundamentally at odds with legal and ethical duties that managers owe to their clients. 2024 was certainly a turning point. After the ABC's sustained reporting culminating in the Four Corners episode, The Strata Trap. Decades of concerns that had been simmering within the sector finally erupted into the public consciousness. What's crucial to understand is that the media attention didn't create these problems. It exposed problems that many in the industry had known for years. The difference now is that strata owners are becoming more aware, and that awareness has translated into a growing distrust of the industry as a whole. I think change is no longer an option, it's inevitable. The question is whether it will be industry-led or imposed through regulation. So what struck me the most when researching this topic was just how long these issues had been documented without meaningful change. So the starting point is actually 1992. The Sydney Morning Herald published a series of articles exposing Alliance Strata Management for undisclosed commissions and affiliated relationship. This resulted in the commencement of a prosecution. This wasn't a minor story, it was rather a significant expose. 2 years later, in 1994, the board of what was then the Institute of Strata Title Management, the predecessor to today's SCA, wrote to its members indicating that they were considering phasing out insurance commissions. Now that was 30 years ago. In 2008, Gary Bugden published a detailed paper warning the industry about the legal risks in its revenue model. He explicitly cautioned managers about their fiduciary duties and the danger of what he said pushing indirect income boundaries to the limits. The 2017 ACCC inquiry into Northern Australian insurance explicitly recommended prohibiting strata managers from accepting commissions, and that recommendation was largely ignored. I, around that same time, published my PhD thesis that really looked at conflicts of interest in relation to the developer and manager relationship. Bugden again wrote in 2021 detailing specific what he called risky dealings that needed to be avoided. And then, of course, 2024, Four Corners aired The Strata Trap. So the phrase I keep sort of coming back to is 30 years later, we're still debating the same issues that should be deeply concerning to everyone in the industry. A lot of people in the industry have asked, why is strata management being targeted? The answer lies really in the structural characteristics of the sector. First, the legal framework is extraordinarily complex. The prescriptive nature of strata legislation requires specialist knowledge that most lot owners simply do not have. Second, we have volunteer committees. These are well-meaning people trying to manage significant assets, but they rarely have strata expertise. Third, the agency relationship itself creates an inherent power imbalance. Owners, corporations, and lot owners are reliant on their managers in ways that don't exist in any other service relationships. Fourth, lot owner apathy is real. Most people buy into strata to live somewhere, not to become governance experts. This means that there's often limited oversight. And finally, and this is crucial, strata management is characterised by dependency on multiple external services. Every supplier relationship, every service provider engagement creates an opportunity for conflicts to emerge. Industries with these types of characteristics, where one party has specialist knowledge, the other is more vulnerable, and there are multiple external relationships, are inherently high risk for conflicts of interest. This isn't unique, of course, to strata. We see similar challenges in the legal, medical, and financial services. Before we go further, we need to be precise about what we mean by conflicts of interest, because as I've said before, this is This is often misunderstood and defined too narrowly. In the presentation I gave for LookUpStrata last year, I went into this in detail, but I think it's really important to go through it again. So the definitions that I use come from scholars, the most well-known scholars in the world that talk about conflicts of interest, and though they are fairly united in what actually, how to actually conceptualize conflicts of interest. So this is important, and I think we should just take this and run with it. A conflict of interest is a situation in which an interest tempts one to disregard a work-related duty, a situation that threatens the interest of someone else. So every time we have a conversation about conflicts of interest, we should be looking at this definition and talking through it. We need to break it down into the elements so we can get it into our heads and keep it there. First, we need to have a relationship. Okay, so we need to think about the relationship here. So these relationships must be based on reliance and trust. So not every single industry or every single business has this issue, okay? You have to first look to see what the relationship is and whether that relationship is based on reliance and trust. So in Strata, that's the manager-client relationship. There are others, but that's the one we're talking about today. Second, there must be a duty. You're going to have to point to the duty, okay, which is an obligation to act in the client's best interests. So again, in some other businesses and service industries, that might not be relevant, but it is here, okay? Because for strata managers, this obligation comes both from legislation, contract, and common law fiduciary principles. Third is the interest, and this has been quite broadly interpreted. Okay, so it's just not about someone getting money, but that is one thing. That's the tangible part of this. That's the tangible interest. But of course, it can be intangible. So maintaining business relationships and those sorts of things can be also problematic here. And fourth, and this is really crucial, there's the temptation. Note what the definition says. You only need to be tempted to disregard your duty. You don't actually have to act on it to be in a conflict of interest, okay? You just have to be tempted. This is important because it sets a really low threshold for what constitutes a conflict of interest. The conflict exists when the temptation exists, regardless of whether you succumb to it or not. Okay, so that's really important to understand why this conversation is so big in Strata, because it's just everywhere. So this brings me to the important nuance, I think, that's often lost in these discussions. Being in a conflict of interest situation is not necessarily wrong. If the threshold is just being tempted, then conflicts will arise regularly in any professional services context. Sometimes you're just placed in these situations through no fault of your own. The real problem, and this is the kicker, is the legal and ethical problem that arises in what you do next. Okay, so it's what you do next. Your subsequent actions determine your risk exposure. Do you evade or try and escape the conflict? Do you just disclose it? Do you proceed regardless? The business models we're about to discuss don't just create occasional conflicts, they institutionalize them. They make the conflict of interest the standard operating procedure rather than the exception to be managed. Before we get to that, though, it's really important to briefly outline the legal framework that governs these duties, because the duties are central to the discussion. There are three main sources. First is strata-related legislation, and that does vary across the jurisdictions, but generally imposes best interest duties on managers. That could be either directly or by implication. In New South Wales, there are specific disclosure requirements, supervision guidelines for managers, and penalties for non-compliance. Second is around crime-based legislation. So this could be the Criminal Code or the Crimes Act, depending on what jurisdiction you're in. But every state has what's called a secret commission's provisions in their respective Crimes Act. In New South Wales, for example, receiving a corrupt benefit as an agent carries up to 7 years imprisonment. These provisions apply equally to those giving and receiving the benefits. So this stuff needs to be taken really seriously. Third, and this is often overlooked, is the equitable doctrine of fiduciary duty, and this is the highest duty owed in law. It has two core rules. The conflict rule, which says you cannot put yourself in a position where your duty and interest conflict, and the profit rule, which says you cannot profit at your client's expense. Fiduciary duty has been, as Gary Bugden put it, systematically ignored in this industry. Yet it's commonly accepted that strata managers owe fiduciary duties to their owners corporation clients. The primary regulatory response to conflicts of interest has often been across the board disclosure. We see this regularly. Governments will look at these issues and go, the best way forward is to provide some sort of disclosure regime. But disclosure is failing. The assumption underlying disclosure is that people are rational. If you tell them about a conflict, they'll discount the biased information and make optimal decisions. This is based on a theory called rational choice. The reality, however, is very, very different. As the research literature puts it, disclosure cannot generally be assumed to be an effective solution for the problems created by conflicts of interest. It may even make matters worse. So there's a fundamental problem that I call the transparency illusion. Governments talk about disclosure achieving transparency, but information can be disclosed yet incomprehensible, overwhelming, misleading, inaccessible, and simply not useful. Think about strata management agreements. The Insurance Commission disclosure might technically comply with the law, but does the average committee member or owner understand cross-subsidisation effects? Do they know how the commission affects their specific schemes? Do they understand the tax implications? Usually not. And even if we fixed the disclosure content, so we made it better, three critical problems will always remain. The underlying duty to act in the client's interest will always still exist. Disclosure doesn't take away the duty. It's still there. That duty is sacrosanct. Disclosure is not consent. Being told something will happen is very different from agreeing to it. And there are profound cognitive or mental impediments that prevent disclosure from working as intended. So the psychology literature goes into a lot of detail that identifies sort of specific cognitive or mental barriers on both sides of the relationship, both for the owner's corporation, which is the duty owed, and the strata manager, which is the duty bound. I'm not going to go into all of this because I'll put everyone to sleep, I think, but it is extensively explored in the paper, and you can have a look at that. And I've written another paper looking at the psychology of disclosure. But I just wanted to pinpoint a couple of things why this is so important, why psychology plays such a significant part in this idea around why disclosure is so ineffective. So for owners corporations, the duty owed, there's some difficulty in what's called judgmental correction. So even when you know to be cautious because something's been disclosed to you to say, hey, here's the alert, you need to be aware of this, estimating how cautious is nearly impossible because you don't know how the whole thing works. You don't know how everything operates. So you don't know how to balance that disclosed information, okay? Especially because it's so limited. You just don't have the ability to do it. So that's a real problem. There's also a thing called insinuation anxiety, which means people often fear appearing distrustful. So they don't question advice when they should. So if you're in this trusted relationship with your manager and they're disclosing this sort of information to you, you want to trust them. You want to know that they're doing the right thing for you. So you often don't then take that next step to find out what's really going on here, to understand it better. You trust them. You trust in what they're saying. For managers, the duty bound, there's what's called self-serving bias, where we unknowingly favour evidence that support conclusions we benefit from. Now, this is not exclusive to strata managers. Every human being has this, right? And there's blind spot bias as well. So we see bias in others, but not in ourselves. This is why this topic is so very difficult for some people to really take in and they get very, very defensive because it's our natural inclination to say we're ethical people, we aren't doing anything wrong, than having to stand back and really look at ourselves. So there is a blind spot for us. Perhaps most troubling, studies show people give more biased advice after disclosing a conflict of interest. So this is based on numerous studies that have been done overseas. And moral licensing means the act of disclosing makes people feel ethical and they're less careful about the actual ethical behavior. And that is a bit of a problem with disclosure. And you hear this all the time, but we disclosed it, we've disclosed it, we've disclosed it. And so therefore, we're ethical, but we haven't actually looked into all those other little nuances that make up what these issues are. These aren't character flaws. They're how human cognition actually works. This is just how we as humans actually work. Disclosure just assumes a rational decision maker that just simply does not exist in the world. Okay, so it's not that these people are just being unethical. There's some psychological barriers that prevent disclosure being effective. The research methodology, as I said, sometimes this can be a bit of a snore fest for people, but it's really important, I think, as more and more people are putting research out in the domain, that we question and explore how people have investigated a study, what techniques that they've used. And I think, and to know who actually is doing the research is really important. I see all the time these things coming out and I don't know who's putting them out. There's nowhere to find out what their qualifications are, what they've actually done. So I think we all have to start questioning this a little bit more. Let me explain how we investigated these issues. So this was a fairly comprehensive qualitative study using what's called methodological triangulation. You don't have to worry about that at this stage. But I've sort of set out the phases so you can understand how I got to the end result. Phase 1 involved preliminary interviews with 6 strata professionals nationally. So these were both manager principals, and lawyers who had raised, concerns about conflicted practices. So there'd been people that had been quite out there in the public domain speaking about these issues. So they really helped us sort of identify the key areas to investigate. That was the purpose of that first phase. Phase 2 was a systematic review of 153 strata management company websites and 35 management agreements, and that was just from New South Wales. So this gave us a bit of an objective baseline of industry practices without too much researcher influence. Phase 3 was really the core of the research. So we did some in-depth interviews with 20 senior strata managers. We recorded over 20 hours of interviews and they ranged from about an hour to an hour and a half each. And phase 4 involved structured engagement sessions with 16 strata lot owners where we assessed their knowledge of conflicts of interest situations, particularly around insurance commissions. So that was quite a deep dive into how the mechanisms work. So this was really important to look at these sorts of different types of phases, these different types of methods, so that we would get consistent themes emerging, so we knew that we were on the right track and we were confident in our conclusions. So let's talk about the conflict of interest areas identified. So these were areas that were mainly identified. So we got saturated data in relation to these sorts of issues. I do believe that there are other things that perhaps are going on, but it might be quite selective in certain areas. But these are the sort of, I think, what we could call the big ticket items. So our research revealed 6 main characters of practices and relationships that give rise to conflicts of interest. First, of course, insurance commissions. It's a widespread practice. This emerged really as a central issue. Managers receive commissions from insurers or brokers based on premiums paid by their own clients. The second was developer consulting arrangements, and again, these were widespread. Managers do pre-registration work either for free or low fees in exchange for management appointments and other benefits. 3, affiliated entities are primarily seen to be a large firm issue. These are sort of both legal and familial relationships where service providers that create additional conflict layers. Staff remuneration. So this is where it's tied to Schedule B's fees. Again, it's widespread. Schedule B is sort of a New South Wales way that the contracts are put together, but basically they're additional fees that they have in all other states as well. Again, widespread where manager pay is linked to additional services, service charges billed to clients. Then, of course, supplier and service provider referrals. And this sort of started to vary in prevalence, where managers receive fees or benefits for directing work to particular suppliers. Now, it seems more variable in New South Wales because I think there's been a bigger focus on it in New South Wales, but I believe that it's still systemic in other jurisdictions, so perhaps more widespread in other jurisdictions. Training and event sponsorship also varies, where suppliers provide free training in exchange for preferred status. So I'll discuss each of these, but insurance commissions really dominated our findings and will receive the most attention. And that's because it's been put on the agenda mainly from the New South Wales government, I think. So one of the most significant findings was really the diversity of ethical positioning within the industry. And we identified four distinct categories. So this was from the people that we interviewed and had discussions with. So the traditional commission dependent operators, I've called them, 6 of our 20 interviewees, and they rely heavily on insurance commissions with 15 to 25% of revenue coming from this source. This is what they told us. They believe current disclosure is sufficient and they're very resistant to change. Then we have the reform-oriented operators, so again about 6 of the 20 interviewees, and they have either eliminated commissions entirely or never took them to begin with. They've implemented higher based fee models and see their ethical stance as a real competitive advantage. These are sort of the early adopters, I think, of proving alternative models actually work. Then we have the transition and the conflicted operators, so about 5 of the 20, and they acknowledge the problems and want change, but are waiting for legislative mandates. So they fear competitive disadvantage from acting alone. And then we had sort of the whistleblower critics, 3 of the 20. And so these people provided detailed accounts of problematic practices. They named specific companies and described what one called a tap and go monetization mentality in the industry. So what this really tells us and why this is important is that the industry is not monolithic. Okay, there are genuine reformers, but market pressures are preventing voluntary industry-wide change. Let's get into these practices in a little bit more detail. So let's start with the insurance commission. So they, as I said, emerged as the central business model dysfunction. And so some of the key data that 91% of the management agreements we reviewed disclosed insurance commission arrangements. Managers told us commissions represent between 15 to 25% of their revenue, and for some, it was the entirety of their profit margin. The most common commission structure is up to sort of 20% of the base premium, but the numbers alone don't really capture the problems. So let me highlight 4 key issues. First is around the cross-subsidisation. Commissions are usually used to subsidise management services across portfolios. This means often that larger schemes or schemes with high premiums due to things like defects or other factors are effectively subsidising smaller schemes. This to me is inequitable and creates perverse incentives. Second is the broker appointment confusion. There's widespread uncertainty about who appoints the broker and under what authority. Many managers believe they can use delegated authority to appoint brokers without owners' corporation resolutions. This relationship between the manager, broker, and owners' corporation is just murky. Third, affiliated broker relationships added another conflict layer. Some managers claim they don't take commissions while having ownership stakes or family connections to broking firms that do. Fourth, owners are largely unaware, not just of the commission itself, but of how the money is used, the tax implications, and the cross-subsidisation effects. So the disclosure regime hasn't fixed any of this. Owners are told a commission exists, but don't understand its implications. Here's some of what our managers said. So these are quotes that illustrate sort of the divergent views within the industry. The traditional operators, if insurance commissions are prohibited, there will be no profit for the business. And they go on to tell about what the insurance makes up for their business in terms of revenue and profit. So this really captures like this financial dependency. So there's this fear that if the commissions go, they're done. They aren't really considering a different type of remuneration model that will ensure that they are a successful business that does make profit. A reform-orientated operator said there is a clear conflict of interest. They're creating complications. We don't need them. There's simply no basis on which logically a strata manager should take a commission. This captures sort of more the ethical clarity of those who've moved away from the model. Then you've got the transition operator, and they acknowledged even our staff don't necessarily really understand how it is all structured. I think majority of owners don't really understand it. And so this sort of really captures how opaque, the problem is. And a whistleblower described it this way. They are trying to monetize every transaction. Your fiduciary responsibilities are to your principal, to the client, but you're also being told there's incentives here. This captures sort of the cultural problem that's going on. So these aren't cherry-picked quotes. They represent genuine categories of industry participants with fundamentally different views on what's acceptable. Developer consulting. Developer consulting emerged as another high severity conflict area. 47% of websites we reviewed promoted these services. But I must say, when I spoke to a lot of people, although they might have it on their website that they do the service, oftentimes they don't do a lot of it. So it's very difficult to gauge what types or what size of strata management firms do the bulk of this sort of work. The model typically works like this. Managers do pre-registration work. They establish bylaws, create initial budgets, advise on structure and so forth for free or below commercial rates. In return, they get the initial management appointment, Section 184 certificate fees, that's New South Wales for those information certificates, insurance commissions, and often are reappointed at the first AGM because of of inertia. The harms to owners' corporations include lowballing of levies where developers pressure managers to create artificially low budgets to promote sales, building defect mismanagement, structures that enable ongoing developer control, and advice that serves developers' interests rather than the future owner's corporation. Multiple interviewee participants describe this relationship as a poisonous chalice. As one said, you just can't serve two masters. And here's the critical point. Only one of the 35 management agreements we reviewed disclosed developer relationships. So there's widespread confusion, I think, about whether this even requires disclosure, with some managers arguing that because no direct fee is charged, there's no relationship to disclose. So the severity of this conflict is the highest of any we examined because of the potential harms, embedded structural problems, defect mismanagement, ongoing control issues can affect owners' corporations for years. And this is certainly a pet area of mine because that's what I did my PhD on. Schedule B billing. So again, these are these additional fees. So the practice of tying staff remuneration to Schedule B or additional service fees is widespread, but receives less attention than it probably deserves. So I looked at some job advertisements just from one sort of in September 2025, and this is sort of what I took from them. So this is sort of standard recruitment language, I suppose. The practice really originated from what I've been told reasonably enough. They were trying to compensate managers for after-hour meetings, but it certainly evolved in something I think more problematic. One whistleblower told us and they named the company, a massive lump of your salary was the Schedule B fees. The more you charge the client, the more you monopolise their time, the longer the meetings went, the more money you get. Another described minimum billing thresholds. We had KPIs. We actually had to charge a minimum of $10,000 for the schedule fees a month to even see a cent. The conflict, I think, is really obvious. Staff have direct financial incentives to charge clients more. Combined with delegated authority to pay invoices and limited owner oversight, the potential for overcharging, I think, is significant. Reform-oriented operators had a very simple response: just pay your staff a good wage. Vertical integration and affiliated entities. So affiliated entity arrangements seem to be primarily a large firm phenomenon. 46% of agreements disclose some affiliated relationship. So this is either to maintenance companies or with maintenance companies, insurance brokers, legal firms, valuers, and more. The core problem is that these structures are designed to capture revenue from the manager's client portfolio. When a manager recommends their affiliated company, are they acting in the client's best interest or their own? One interviewee captured it perfectly. So it's a valid business model saying, we know you're busy, we take care of everything for you, which is a recipe for temptation. It's a recipe for inflated costs without the customer's knowledge. The most contentious issue that came out of the research was affiliated insurance brokers. So multiple managers expressed frustration at competitors who claim that they don't take a commission while having a shareholder or directorship or other type of arrangement in broking firms. As one said, forget about the issue about transparency and people going around saying, oh, we don't accept commissions, but we've got a shareholding in the company that creates profit. I should note that in regional areas, some affiliated arrangements arise out of necessity because there might be limited local suppliers, which means managers sometimes there's a crossover with family businesses and those sorts of things. I think there needs to be some structure and procedures put around those sorts of things where it's very difficult to get someone outside of your area. The dynamics there are very different from metropolitan sort of integrated service models, I think. So our engagement sessions with strata owners revealed significant knowledge gaps and profound trust erosion. Owners understood that managers receive commissions, but they don't understand the structures. Tax implications, as I said, cross-subsidisation, how commission money is used, broker arrangements, this was all unknown territory. When we explained cross-subsidisation in detail, so we spent a lot of time going through the whole process, that their scheme might be paying for services to other schemes, they were genuinely shocked. Participants dealing with defects felt particularly aggrieved, recognising their elevated premiums were subsidising others. The consensus was clear. They wanted fee-for-service types models. One owner put it simply, I would be much happier paying a fee for a service rather than a bit of palm greasing here and there. When told the industry argues that owners prefer the commission model, one participant responded with a single word, rubbish. Trust erosion was palpable. Multiple owners stated directly that they do not trust their managers, particularly around insurance and affiliated services. One owner who came from a business background captured the broader sentiment. Of all the industries that I've worked in, there isn't an industry as much as a dumpster fire as strata. It's just so convoluted and so much stuff is happening that is not transparent. So let's go and have a look at, we went through a process of assessing the severity of each conflict of interest area using sort of criteria that had been established by other scholars. That looked at sort of the likelihood of the undue influence and the seriousness of the possible harm, because, of course, there are different impacts to these different types of practices. So in terms of insurance commissions, they rate high on both measures, both in relation to influence risk and potential harm. The financial value is substantial, where you've got 15 to 25% of revenue, and the potential harms are significant, particularly cross-subsidisation inequities. Mitigation through disclosure has failed, and I think a ban is required. Developer consulting is the highest severity. The financial incentives includes the ongoing management fees and all associated benefits. The potential harms, as I've already outlined, structural problems, defect mismanagement, ongoing control, can persist for years and years and years in these schemes. I think there has to be a separation of consulting and management. Affiliated entities, again, rate high for influence, medium high for harm. I think there has to be independent validation of transactions. I think that's needed. Schedule B incentives rate medium high for influence and medium for harm. So there's policy controls within companies can help, but the practice needs to be examined. Supplier referrals and kickbacks, as I said, vary, but it might just be jurisdictional dependent. But I think elimination is the only option there. Just you can't be involved in any of that sort of stuff. Training and sponsorship are lower severity, but still need management through other types of mechanisms, sort of around, things like rotation of providers and that sort of thing. The key message is that the most financially significant practices, insurance commissions, developer relationships, are also the highest severity and cannot be adequately mitigated. They require structural reform. Let's get on to some key conclusions here. So let me draw sort of 4 key conclusions from this research. First, we're dealing with systemic industry dysfunction. These aren't isolated incidences or a few bad actors. Conflicts of interest represent a fundamental structural problem that has been institutionalized over more than 30 years. The business models themselves are the problem. Second, disclosure-based regulation has failed. Disclosure has created what I call the transparency illusion. It gives the appearance of accountability without ever achieving it. Complexity, cognitive barriers, and the gap between disclosure and genuine informed consent means this approach cannot work. Third, voluntary reform, I think, will not succeed. The competitive pressures are too strong. Transition operators told us explicitly they want to change but fear being undercut by competitors still operating under the old model. Government intervention is essential to create a level playing field. Fourth, and this is the hopeful note, viable alternatives exist. Reform-oriented operators have already demonstrated that ethical, profitable business models are achievable. They've implemented fee-for-service approaches, eliminated commissions, and maintained successful businesses. The path forward, I think, has been proven. I just want to talk about some policy recommendations. So I've made 4 policy recommendations for government to consider. First, I think we need to prohibit insurance commissions, not more disclosure, an outright ban. And critically, this ban must extend to insurance brokers, not just strata managers. The cross-subsidisation model creates inherent conflicts that cannot be mitigated through transparency measures. Second, separate developer consulting from management. Companies providing pre-registration consulting service should be prohibited from receiving initial management appointments. This is the only ethical pathway to eliminate the competing loyalties that harm owners' corporations. Third, restrict affiliated entity dealings. Require independent third-party validation from any related party transactions. Prohibit use of delegated authority for affiliated engagements. Mandate competitive tendering with independent oversight. Fourth, reform delegation powers. This is very important for New South Wales and probably Victoria. Limit the scope of delegated authorities, particularly for financial decisions. Require explicit owners corporation approval for insurance broker appointments and supplier engagements. Although this research has primarily focused on New South Wales, these practices and risks exist in every state and territory. All jurisdictions should consider these reforms. Some industry implications. So this is beyond government action. I think the industry still needs to change. The first one is on pricing model. The shift to a fee for service, I think, is inevitable, or another type of model that I'm not wedded to the fee for service model, but I think it's a good starting point. Management fees will need to increase to compensate for lost commission revenue. Itemised monthly invoices should be sent to committee treasurers for approval prior to payment. Transparency must become the competitive advantage, not the obstacle. On professional development, the industry needs genuine investment in ethical training with emphasis on understanding and recognising conflicts. The current SCA Code of Ethics should be reviewed and strengthened. Managers need to understand not just the legal rules, but the ethical principles behind them. In terms of accountability, auditor rotations should become standard, with auditors reporting directly to owners' corporation committees before engaging with managers. Independent reviews of management practice should be encouraged. And critically, supplier and service providers need to change too. The kickback culture and training for preferred status arrangements, the pressure tactics, these need to end. The industry cannot transform while the surrounding ecosystem maintains conflicted incentives. For reform to succeed, 4 factors are critical. First, legislative mandate. I cannot stress this enough. Voluntary reform will not work at an industry-wide level. The competitive pressures are too strong. Government must create a level playing field through regulation. Second, transition support. This will be disruptive for managers who need to restructure their businesses and for owners who may see fees increases. Clear implementation timelines, industry guidance, and consumer education programs will be essential. Third, enforcement mechanisms. New regulations must have teeth, meaningful penalties for non-compliance, regular auditing and monitoring, and clear complaint resolution processes. Rules without enforcement are just suggestions. Fourth, industry leadership. Reform-oriented operators should be recognised and supported as examples of viable alternative models. Industry bodies need to provide genuine support during transition, not just defend the status quo. I just want to leave you with this core message from the research. The strata management industry has reached a critical juncture where institutionalised conflicts of interest have eroded trust to such a degree that only comprehensive legislative reform can restore the integrity of the principal-agent relationships that should be at the heart of strata management. Yes, reforms will be disruptive. Fee structures will need to change. Some businesses will need to adapt significantly, and there will be transition costs. But reform is both necessary and achievable. The early adopters have already demonstrated that ethical, transparent business models can be profitable and sustainable. The question is not whether change will come, but whether it will be led by the industry or imposed upon it. I hope this research provides the evidence base for that change. Thank you for listening to me. I know it's a difficult conversation to have. It's a difficult topic, but I think it's really important for the industry and everyone involved in Strata to take note of it. So thank you for your attention. As I said, the full report is available. I think Nikki's got the link there or through my website. Thank you very much for your attention.
Thank you so much, Nicole. We had a few questions that came up in chat that we just might point to first because they did refer specifically to the report. How did you select your sample?
Yes, so a number of different ways. In terms of the agreements, I did receive a lot of different agreements. I've got a bit of a stack, especially from New South Wales. We looked at all the ones that we had. Again, in the websites, I got a huge big database and just went through every single website that I had, looking at those sorts of things. I think I put a LinkedIn thing on to see if any managers wanted to be involved in the project. I did also have a database, and I did ask lots. Like with these sorts of things, you ask a lot of people, and you don't get everyone saying yes to participate in this sort of project. So I did send out a lot of information to the principals of different companies, asking them to participate. So that's how I got my sample.
Predominantly New South Wales?
The first 6, I selected them because they were people that have been advocating for change and that sort of stuff. So I went directly to those people. But for the other ones, it was all New South Wales specific.
How is Fair Trading going to use your research?
Yes, well, let's see. I just want to be really clear about this particular project. So I had started this project. I was doing it independently through my company Strata Knowledge, with no one else was putting any hadn't partnered with this. So I was about halfway through this project when a lot of this stuff started coming up for New South Wales fair trading, and they got in contact with me to say, we've got some questions, Nicole, what does the research say about this and that and this? And I said, well, the research hasn't been done on it. I'm doing it. If you want to come on board, I can make it more New South Wales centric. And that's why it became a little bit more New South Wales centric, because they came on board because they had specific questions. But I was very clear about, as I am, about my independence, and that they can't, obviously interfere in any sort of outcomes or direction in relation to the research. which they're very aware of. So that's how they came on board. Um, I sent it to them as soon as I'd finished it. I know they've read it. I know the Productivity Commission has also read it. And so where we go from there, I don't know. I sit back and wait like everyone else.
Okay, wonderful. And definitely all eyes are on New South Wales at the moment, aren't they? You would
Yeah,
say.
but I think everyone else should be looking at it. I
Mm.
think it's a real mistake to think that this is a New South Wales issue. Um, New South Wales is the one that is having to deal with all the people in New South Wales. I do feel for them because they're the ones where, we're all looking at in relation to this. But this is widespread. Every state, every person in every state needs to be having these conversations and looking at it. I think it's important to just make sure that this is not just not a New South Wales thing.
The related issue to conflict of interest is strata managing agency agreements. Can Nicole give the webinar any update on her work for the New South Wales government in developing a standard form managing agency agreement?
Yes, so I
Yes.
was busy last year. So this research, this is a different project that was commissioned by the New South Wales Fair Trading, and they asked me originally if I could draft a new strata management agreement that would go to consultation, whether they would make that as a template or mandate it. Whatever happens there, I don't know. I said to them very clearly, before we get to that, we need to understand what the issues are. We need to undertake some research. So I did a very, very detailed research project, much bigger than the conflicts one. So if you found that report difficult to get through, you wait for the next one. But it was really important. A lot of things came out of that project in terms of both reform, legal reform. It's not just about that these management agreements are problematic. There's some structural issues there that need to be, I think, dealt with, and there needs to be broader conversations. And so that was a much bigger piece. So an agreement has been drafted. And from my understanding, so that was finished in December. So I gave that to New South Wales Fair Trading in December. That, from what I understand, again, I just give it over and see where it goes. I understand that sometime it's going to be all publicly available. That was part of the agreement that we made. So I think it's going to go out for consultation. And I really do hope that we have a big conversation about this piece. I don't think the agreement is perfect. I want to hear from people on the ground how this template agreement would work. It has to be critiqued. This all has to be critiqued. It's really important to have these conversations. I don't have any dates for anyone, but I gave it to them in December. So I know they're reading it and looking at it and digesting it, but there was a lot in it. And so that will be a big conversation, I think, for this year. So, yeah, so last year was a big year for me. We'll see what this year brings.
Well, when we hear more about that one, Nicole, and you get some information back and it starts to be released, we'll have you back. Should a body corporate manager nominate the auditor for approval for the body corporate? Our body corporate manager acts as the principal manager and record keeper for the scheme's financial dealings, including bookkeeping. If the body corporate decides to have its financial records audited, the body corporate manager usually nominates the auditor to be included in the motion put to owners for approval. I want to understand whether this is appropriate for the body corporate manager to select or recommend the auditor in these circumstances, given their role in managing and recording the financial transactions that are being audited.
Yes, excellent question. Very, very glad that this is raised. It's not talked about enough. I've always had concerns about this, and I've seen where it has gone very bad. This sort of relationship. So I think really, really important. And I'd like to probably see owners and managers and probably some of the accountants and auditors come together to try and put a better procedure in place for this. I've always been very much, and I see this all the time. You get to the AGM and someone's name's just been put on there and you don't know who they are, and it's really a problematic procedure. I think managers also, just to give them a bit of due, they know who's in the industry that is probably good at doing auditing and accounting for strata schemes and those sorts of things. So oftentimes they're probably putting forward the people that they think are the best. And I think I understand when they sort of use the same auditor that's probably a very good auditor for the whole of their portfolio because there's efficiency. They send out the same sort of reports. They've got the same, relationship that they can ask questions for and get these sort of things right. So I don't think, they're out to do anything, necessarily do anything harmful, but I have seen harm happen because of it. And so I would always suggest that the strata manager puts forward different companies. Don't just put one. At a committee meeting, say, we're putting up, a motion to get an auditor at your AGM. These are the ones that specialise in strata accounting or auditing in this state. I know it's very difficult in some of the more regional areas. It's very difficult. These are the ones we prefer and why we prefer them. Be really clear about that. Let the committees do some due diligence about the auditor that they would prefer, perhaps based on that, or they can go out and do some more work and they can nominate who that company is. I also think it's really important that the treasurer, at least, is CC'd into every single piece of correspondence that goes to between the manager and the auditor. So this idea that I've heard that there's these two letters that come out. One letter goes to the manager to sort of fix up some of their stuff, which I understand. There's probably some just little mistakes that get made because people are human and that sort of things, and things change and that sort of stuff. But to be transparent, there should be this part in particular should be very transparent. And I would be saying to the manager, if I was a lot owner, I must be CC'd as a treasurer or the chair or whoever you are, copied into every piece of communication that goes back and forth in relation to our scheme from the nominated from the appointed auditor.
Okay.
But I think there could be other things that could happen, and maybe that should be a conversation. That auditors and managers and perhaps bring some owners in to have a discussion about how do we make this much more transparent.
Okay, that's great. I've written that down because I will check that and see whether we're doing that. I like that
I don't have all the answers to everything. I just have some suggestions about maybe what you can start to, move. Yeah.
That's really great. I like that though. CC the treasurer in, so the correspondence is transparent between them. The other thing I was going to say is that this day and age too, the auditor doesn't need to be in the same town even, do they? Because with access to electronic records, they can be anywhere really. So it does open up the pool quite a bit from that national perspective. Okay, that's great. Thank you for that. And another question, after the past few years, there's been a lot of scrutiny on the strata sector, and we've seen smaller management companies come forward with more transparent, no commission models. But when it comes to the big firms that were criticised in previous reports and investigations, have their practices really changed? Do you feel the spotlight has led to genuine reform among the big players, or are the same issues still occurring behind the scenes, and will this ever change?
I hope it will change, Nikki. I really hope it will change. And I think it will. I think there'll be changes happening more, than we've ever seen. So change is certainly afoot. I don't necessarily see this as a big firm, small firm thing. I've seen smaller firms doing some really problematic stuff, because maybe they're in a smaller community, they're not so, I suppose, seen. The thing with the larger firms, oftentimes they have these integrated models. So they have, affiliated entities that seem to highlight, sort of put a bit more of a spotlight on them. I don't know, because if I can get in behind the scenes and see exactly what's going on, that would be helpful. I mean, we've seen over Christmas a large firm in New South Wales that's been, reported a lot, come out to say that they're moving away from an insurance commission model. But what else is happening? I don't know until, unless I could get behind there and have a look, or, for people to tell me what's actually going on behind the scenes. I can't answer that question. I hope that there are just more conversations being had about this, and people must be looking at this, whether they're in a big firm or a small firm, and having conversations about it. I think if they're not, I would be concerned. And I know for some small firms in particular that are very highly dependent on insurance commissions, this is really going to be very difficult, very, very difficult for them. Some of them may not be able to sustain that model if they don't start making some real change. I do feel for that, because it's an entrenched business model. But my part of this is, I'm just a researcher, so I just want people to have those conversations and sort of sit back and think, because I think people can get very defensive, as I said, about this topic. And I've tried to explain, that you're in a sector where conflicts of interest are just everywhere. And it's just you now sitting back to question every little thing. If you have a little bit of gut reaction to something and think, oh, I don't know where I am on the line. Like, is this really problematic? These are the conversations people should be having. And, to see, whether they need to sort of start to move away from some of these things or not. So listen, it's not easy. It's a really complex area, but, and that's why I said support around this is really important to have these conversations. We should be having more of them at a national level. And people need to be honest and open about what's actually going on, so that perhaps we can look at mitigation strategies or what other things need to happen to make this better.
Okay, and that leads into the next question, which I think will have to be the final question because we have gone over a little bit. And that was, why do you believe governments have been slow to outlaw commissions and other kickbacks for strata managers?
Yeah, again, a really good question. I think strata has been an area that's been largely ignored across the board for many years by government. Even though they're involved in obviously regulatory reform, they haven't really understood how things work in practice, the relationships with people, how strata really works in reality. I think they've heard things over the time, but I think the media attention certainly has sort of been has sparked them, to do something about it. I was at a conference last week and we were talking about how planners don't really understand, how strata actually works in reality and the obligations that are then placed on lot owners to deal with, common property elements that maybe, perhaps are usually sort of in the purview of local governments, but are now being pushed onto lot owners and those sorts of things. So we were talking about how they don't really understand how strata works. So it's a complex sector. And so I think it's just been largely ignored, but now it's getting to a point, and I think the numbers are increasing. We've got more and more people living in strata. And I think it's sort of now, just more in the public domain to have this conversation. I find it sad that only a few states are really having these big conversations. I'd like other states, including my home state of Queensland, to be having more conversations about this, which I think will eventually happen. I think there'll be a trickle down effect after, watching New South Wales. But yeah, I think they just haven't really understood the intricacies of strata, and I think New South Wales, with having a commissioner, starting to sort of really focus on and get a better idea about what's going on in strata. So I think it's just been, it hasn't really been on their radar as a big thing, and it should have been.
Okay. Well, hopefully those times have changed. And we thank you very much for the work that you do in this space, Nicole. And we're very happy to have you on and be speaking to our audience about it as well, so that it is out there and we're having those national conversations. We've got people on from all states, I think, in Australia today, which is fantastic. Hopefully we'll see you later on in the year with information about the new report that you put out,
Yeah.
which we'll all be waiting to hear about. And
Yes.
yeah,
And
we
maybe
thank you very
maybe going
much.
to do something a more happy, a more upbeat sort of project. It's all good stuff.
Yeah, that's fantastic. All right, that sounds really good. And is there anything that you'd like to leave us with? Any wrap up comments, Nicole?
This is an incredibly difficult topic, and it's very complex, and there's lots of different conversations being had, but there is movement forward. I'm a big supporter of the strata management industry. I think they do an incredible job. I think it's a very, very difficult job to do. The problem has been these embedded practices that everyone needs to start to think about and move away from. I hope all this, this project and the research findings really just stimulate conversations with people. We just all need to be participating in this conversation better.